So today at the day I'm recording this, it's Wednesday, January 15th. The stock market is climbing very, very rapidly. The Dow Jones is up 700 points as I'm recording this. It's been a very strong rebound for stocks, and the biggest reason is inflation data. So before we get started, please take a minute and check out the link you see on your screen, fool.com/Frankel. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. So we're going to talk about what inflation data we saw, what it means, and what industries and some specific stocks that I think could do really well based on just what we're seeing right now. So let me go ahead and share my screen. All right, so we've kind of seen not one but two pieces of inflation data that were really impressive over the past week. So yesterday on Tuesday, the 14th, we got producer price index data. And that was flat month over month in December versus expectations of a 0.3% increase. Core CPI data came in at 3.2% year over year, and that was today on Wednesday, January 15th, and that was slightly lower than the expectation. So the kind of key takeaway here is that the PPI data was good. It was on the right track. It made the market go up a little bit. And CPI showed that it was not just kind of a one-off thing, that there is actually multiple sets of data that are pointing toward inflation kind of starting to moderate more than people think. So what that means is expectation for interest rates are going down significantly. So if I go out all the way to, this is CME Group's FedWatch tool, it shows how many interest rate cuts or hikes or whatever are priced into the market right now. And here's kind of the key thing. So this was yesterday. This was on the 14th right here. By far the largest expectation, currently we are here. This is where the federal funds rate is right now. The largest percentage expectation was for one level below that, or one more interest rate cut in 2025. That was a pretty muted expectation. So that's still the biggest percentage. But after the inflation data we've seen this week, the chance of no rate cuts, which is this right here, has declined from 26% to about 16.5%. The chance of just one rate cut has gone down, and the probability of two full rate cuts has gone up by more than 5 percentage points, and the probability of 3 rate cuts this year has gone up significantly as well. So the takeaway is that we are seeing expectations for interest rates start to go to interest rate cuts to start to lean more aggressive. So that could be a big deal for the stock market, and that's why you're seeing stocks as a whole go up right now. So if we look at what industries specifically might benefit from this, there's, just to name a few of the top beneficiaries, financial services, banking stocks, real estate stocks, small caps and value stocks. But really, if you see right there, most of the stock market would benefit from lower interest rates, as long as those lower interest rates didn't also accompany a recession. Now, if we get lower interest rates because, a pandemic begins, remember in 2020, the Fed did an emergency massive rate cut when the pandemic started. That's not a good thing. If we get an unexpected recession or a war starts or something bad happens, that's not the kind of rate cuts we want. We want rates to go down because inflation is moderating and the economy's strong. That would be a big net positive for most of the stock market, but these 5 things in particular. So just to kind of go through these one by one, if we look at financial stocks, so bank net interest margins, they've been under pressure for the past couple years now by rising rates. The short version is that the costs banks are paying for deposits and other sources of capital have increased significantly, and the yields they're getting from their loan portfolios have not really caught up yet. So, for example, if a bank has their deposit costs go from 1% to 4%, and their loan portfolio yield might have only gone from 9% to 10%, then it just hasn't kept up. So we've seen net interest margins pressured by rising rates in a lot of cases. And there's a lot of financial services companies that are on more the technology side of it or the brokerage side that can also be winners from lower rates. Just to name a few that I really like for 2025, Bank of America, BAC, is my largest bank stock investment. and is really well positioned to benefit from falling rates. Their deposit cost is low, but not low enough. It's increased significantly. Very well-run institution, should be just fine no matter what the market does or the economy does for the rest of 2025. Good beneficiary of political headwinds or tailwinds, actually. The banking industry is, for example, if there's a corporate tax cut, the banking industry is likely to benefit more than most. Some others I really like in a lower rate environment is Upstart. Upstart, they're the lending technology company. They pretty much facilitate loans on behalf of third parties, and loan demand is not. It's related to the interest rate environment. Lower rates, more people are interested in borrowing money. So that could be a big catalyst for that stock. SoFi is one of the ones that has a high deposit rate. They're currently paying a little over 4% for deposits. That could come down significantly, and most of the loans on their balance sheet are, 5-6 year terms in nature. So the yield that they're getting should pretty much stay the same for a little while. Their margins could benefit significantly from lower rates. Robinhood, the brokerage company, is another one in the financial industry that I think could benefit a lot. Lower rates, higher stock market, more investor interest, more money flowing into Robinhood accounts. There's a lot of different reasons that brokers can win from a falling rate environment. But Robinhood in general should be a big beneficiary. Real estate investment trusts, they generally rely on borrowed money to grow. Commercial real estate values are linked to the interest rate environment. So if interest rates fall, commercial property values should rise. That's especially true in properties like offices and industrial. You see the first one on my watch list right there is Prologis, which I already own a little bit of, but I think is just an incredible value right now. Prologis is the industrial real estate leader. That's why there's a picture of a warehouse right there. They own, a lot of those large scale like Amazon warehouses and things like that. So Prologis is one that I think could be a big winner if rates fall. Realty Income is another one. They are one of the largest REITs in the world. They have 15,500 or so properties right now, mostly freestanding retail, but a few other property types as well. That's been beaten down as rates have risen. And Vici Properties is another favorite of mine. They're best known for their casino properties. They own a lot of properties in the Las Vegas Strip, a lot of regional gaming properties, and they could be a big winner in the interest rate environment as well. Small caps and value stocks were also on that list. Small caps and value stocks, they tend to be more debt reliant than their larger counterparts. They also tend to benefit more as kind of investors are willing to take on more risks. Just think of it this way. If you are not a very risk tolerant investor, you might buy a mega cap like Alphabet for your AI exposure or something like that. You might be more willing to, look for smaller up and comers if you're willing to take more risk. So as more people want to put money in the market, take money out of risk-free assets like CDs and treasuries, and money flows into the market, that kind of favors small caps. I've been buying ETFs this year, especially VTWO and VB. Those are the VTWO is the Vanguard Russell 2000. So definitely that's the one I've been buying really a lot of. So check those out if you're looking for some small caps and value. So hopefully you found that informative. I'd love to know your thoughts. Do you think interest rates are going to fall faster or slower than the market seems to think right now? I'll do my best to answer any questions individually, and thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.